All right, hey, welcome to the last week of new material, and this week 14, starting Monday here, April the 20th. We're going to, the first thing I have up here on Blackboard is we're in the rental properties chapter, which is chapter 8 of the textbook. Typically when I do this in our normal classroom, this subject matter doesn't take us very long. So this should be a pretty short lecture week. I'm looking at probably 35, 40 minutes of that. So what I have for the other part of the class then, since it's a 3-hour class, is I have a guest speaker come in. And our guest speaker is a local CPA who has his own business and he's owned it for quite a good while. Either had his own business or was in partnership with another individual and running a CPA office. So I think it's pretty important for those that are thinking about possibly going out and starting up their own business or going to work for somebody for a little bit and want to start their own business at some point in the future. This kind of gives you a good, just an overview of somebody actually in the field doing it. So we go in here to session 14, and I make it extra credit. In future semesters, I may even make it mandatory. I think it's pretty important. So we're going to be going through the notes here. Note here I have begin working on the VITA Advanced exam. That won't be officially until next week and the final week. But just to get a start, since this is somewhat of an easier week, you could go ahead and get started on that and have that one maybe pushed away before some of your other finals become due as well. So I give you the link and the multiple choice questions to make sure you watched it. You could actually open up the quiz to write down what some of the questions are, or have it open as you go, and then watch the lecture in another pop-up screen. So you can go along and listen for the answers as they go. All right, so let's go into chapter 8. It's the only thing due this week. Notice there is no tax return due this week, nor a discussion board, but you could go in and actually do a discussion board. It's our final one. It's technically not due until next week, but it gives me your overall thoughts of the class, and I really take those seriously, so I appreciate it, as the two who I've done so far as of today put a lot of time and effort into your discussion boards, just as I put a lot of time into this class. Okay, I'm going to pull up my Word document now. So before we even start in this chapter, let's take a look at chapter 8, page 8-6. So if you need to pause it for just a minute, go ahead and pause the lecture, get your book, and page 8-6 is where I'm going to begin looking here on Schedule E. Okay, so I have the Schedule E here in front of me. You'll notice that Schedule E and the one we worked with just a few weeks ago, Schedule C, owning your own business, look fairly similar. A lot of these, you'll notice at about line 3. Line 3 is your rents received, so that's just like your revenue in a business. And then your expenses, that's very similar to what the expenses look like in Schedule C. A lot of the same ones. We got the auto, the car fee, maybe possibly you're using the mileage there. Then we got the depreciation. Depreciation is usually one of the last ones because of for calculation reasons. Sometimes depreciation may not let you go below 0 for some rules, and that's why they do that one last, and why in Schedule C it's the last two. One of the reasons why you might think then, why do we even have a difference between Schedule C and Schedule E? And the one big one is because what I have on the screen here to introduce this lesson is Schedule E with this rent is a different type of taxable income than any other business you might own. I'll say 90% of any other business you might own. Most businesses that you own are going to be considered active income, whereas with a rental property, most of the time it's going to be considered passive income. You're not really out there doing day-to-day labor for the rent money. You do have to go out and fix some things sometimes to collect the money, but on a general rule, you're not doing labor every single day, whereas if you had your own business, you were. So therefore, the tax laws are a little bit differently since it is considered a passive income. The main rule is you can offset income within each category, and there's no limit one way or the other. But when you start differentiating categories, you go from active to portfolio or portfolio to passive, they don't offset unless there's a special tax rule. For example, remember a couple weeks ago when we talked about stocks. Stocks, you can have a big loss, but you can only take, if you remember, $3,000 a year. Because if you had a stock gain and stock loss, you could each bring that done no problem. But if you only have a net loss left, and it's $10,000, and then you had active income from your regular job of say $100,000, you could only, of that $10,000 loss, you could only take $3,000. The special tax rule says, even though the law says you can't net these guys and combine them, we will allow you to take $3,000 a year. Similar with a passive income. Generally with passive income, you can't offset anything against active. So if you have a loss, well, you just have to wait until you get passive income the next year maybe with your rental business. However, there's one big exception. So here I have that passive losses you can't offset with any other type of income, the active or portfolio. The two major areas of exceptions here where having a rental business, you could take a loss. The first one is if that's all you do. If your company is simply you are doing rentals and that's the only way you make money, you do that on a day-to-day like anybody would with their normal business, then you're actually considered a professional real estate person, and you would file Schedule C instead of Schedule E. Schedule E is for those who don't do rental on a day-to-day basis, and that isn't their old-time job. Those who are professional, who maybe have hundreds of houses that they rent out and that they own, they would be considered in the professional real estate business. And therefore, they could then deduct, because they're doing it on Schedule C, they could deduct their income or any losses that they may have. So notice a couple requirements. 40% of your personal work time is dedicated to this business. So you spend quite a bit amount of time. And you spend at least 750 hours in your rental business. So 750, that equates to about 15 hours a week at least, over if you were considering a 40-hour work week. The other exception, that you can deduct some losses on your rental business, and you're not a professional, meaning you don't do it all the time for your main job. The tax law says we will allow you to deduct up to $25,000 in losses each year, as long as you are actively participating in the management of the property. Actively participating, as I show you down here, what that means. Actively participating, there is a difference between material participation and active participation. Active does not have to be a regular, you're there every single day fixing problems or collecting money. If something goes wrong, you're active means you would be the one taking responsibility for it. And you're the one that does the decisions. You decide if somebody's going to rent from you or not. You don't give it up to a company and have the company do all the work for you. Because a lot of people would do that. Say they own a condo down in Florida, but they live in Indiana. They can't fix something that breaks every single time, so they pay somebody to watch over their rental, and the client, whoever is the rental people, they'll actually call your company down in Florida to take care of your problem, and they collect the monthly rent, and then they take out a fee. In that case, you would not be an active participant, and you wouldn't be able to qualify for this $25,000 loss. Notice that $25,000 loss does have phase-out rules. So once you reach $100,000 in AGI, then you are subject to hitting that phase-out. And over $150,000, then you no longer get to take any $25,000 loss, any of that for the year. Notice the $25,000 is reduced by 50% of the amount exceeding the 100,000 AGI. So, just for example, if you had 101,000 AGI or modified AGI, 50% of that 1,000 would be 500. So you would have to take 500 off of this $25,000 limit. So you'd be able to take a loss of 24,500. If your AGI was 150,000, you are over the limit by 50, so that's 25,000 if you cut it in half. 25 minus the 25 you're allowed, that's why the cap is at 150. So that explains where the 150 comes from. You're all phased out once you reach 150,000. I give you some little pointers here on whenever they give you your MAGI, modified adjusted gross income. So they're taking your AGI and just tweaking it a little bit, and that tweak says they're not including any IRA deductions, so you have to add that money back if you had any IRA deductions. They're not going to include any Social Security benefits that were taxable to you, so you get to take that back off, which is good. This one's not good. Any deductions you took on educational loans, they take it off, and not including any losses thus far from any other rentals. So just to give you an example of what the modified means, tweak. So I have a couple examples here just to walk through. We have somebody who's retired, rents a home, one home, they're retired, definitely not a full-time job, and they rent it for $500. However, the monthly rental was $500. However, there was quite a bit wrong. They had to do quite a bit of expenses, $10,000 in expenses for the year. Modified AGI at $50,000, so they don't hit that phase out, the beginning number of $100,000. So how much can they take, and then how much is the tax law going to allow them as a loss or a gain if they have income or loss on Schedule E? Let's go through the answers now. Again, take your time, pause each lecture, and work out these examples, and then see if you get what I do as we go through them. So total income was $6,000. All I did is 500 times 12 months. Less the expenses, so we had a realized loss of $4,000. And then since the modified AGI didn't hit any cap, and we're allowed to take $25,000 a year, we can use all $4,000 of a loss for this year. See, we could actually put down a negative $4,000 on the 1040. And if you were wondering where that goes, if you go back to the 1040, which I always refer to the one on page 2-3, in chapter 2, page 3, your amount of income, or in this case a loss, goes on line 17, rental real estate. And it just derives over from your Schedule E. Okay, let's look at the second example just to see how things are a little bit different when you have a larger loss. It's probably, could be a poor example. I can't think of very many times when you would have expenses of $40,000 in a rental activity with just one house. Because if you had something that major, you could have expenses that high, but typically those are going to be capitalized, meaning you have to depreciate them. So this is an extreme example, yes, but to show the point of the $25,000 loss limit. Because if you put on, say, a new roof and you had to redo lots of things, those are going to need to be capitalized and depreciated over the life of the asset and not expensed in year one. A roof is going to last you way more than a year, and it's a considerable amount of money, so it would be a depreciable item. So in example 2, everything is the same with revenue except the $40,000 is our new expense. So we have a realized loss here of $34,000. However, we can only recognize for this year the cap, the $25,000 of what we're allowed. The rest of it goes into passive losses, and we would have to offset that next year with any rental income we may have or any other kind of passive income we may have. So we don't lose the extra $9,000, we just have to not use it this year. Okay, the last item here, we have some expenses, same monthly income, except now our MAGI is quite a bit higher. We are over that $1,000 threshold. And remember, for the amount that you're over, so we're over by $30,000, we have to take half of that. Half of 30 is 15. So we're not allowed. We have to take 25 minus the 15 we're not allowed. We can only use $10,000 in losses to offset our income. So we have a total loss here of $11,000. We're only allowed to use 10 of it because of the phase-out rules. The rest of it would be considered a passive loss to hopefully get offset next year. Okay. Let's this next part where I'm beginning to introduce if you have a vacation home and the order that you have to start deducting your expenses. You don't take them necessarily in just any order you want. Depreciation is one of those that's always last. Always have to take that one last. And one of the first ones you always take is your mortgage interest that if you have any on your rental home. Notice that's the mortgage interest, not how much you're actually paying on the loan, on your debt. It's just the interest part and any real estate taxes. You get to take that first, or you have to take it first, because there's a chance that if you use this as a vacation home, then you can use some of it for your own self. If you use it as a vacation home, you're using some of your vacation home as personal use, and then other times you're using the vacation home for rental income. And you'll want to split that mortgage interest up, and the real estate taxes can use some of it for your own self on your Schedule A. And then some of it you're going to use for Schedule E, rental income. And then I talk down here, I think this is important too. Section 179, remember that's where you can depreciate an entire asset completely down to zero as long as you're within the limits. We talked about that back in Chapter 6. So to get away from having to depreciate every single item, Section 179 can't use that in rental activities. For whatever rule, whatever reason, Congress decided they're saying no, Section 179 not allowed. So you have to depreciate your rental activity according to makers. And so I remind us here, like I was just talking about before with those big expenses. In example 2 and 3 above, any major cost in your home, and I mean by major is it increases the value of your rental property, and it has a useful life of more than a year, you're going to have to depreciate those. And I give you some examples here. Putting in a new floor, a garage, maybe extending on a garage, putting down carpet. All of those items we would have to capitalize and expense. All right, so now we're moving over to the vacation home part. So it's not completely rental, generally, because if it's a vacation home, you're probably going to use it a little bit yourself. And most of the time with vacation homes, you have somebody else take care of them. So the $25,000 loss isn't going to be allowed because you've hired some other company to see who's going to be able to come in and use the home, and they're generally only going to be there a week or a month at a time and not extended like a typical rental home would be. So 3 categories here: primarily personal, primarily rental, and combination. If you're primarily personal, notice the exact wording the tax law says. You've rented it out fewer than 15 days, so that's 2 weeks. 2 weeks or less you can rent, and it's still considered primarily personal. If that's the case, notice these two guidelines here. Any income you have, this is one of the few things I can think of in tax law where you can give income that's typically income, but if you rent it for 2 weeks or less, none of it's taxable. It's kind of getting free money. And your expenses, none of the expenses, therefore, would be deductible if you're not counting any of the income as income, which would make sense. So what we're going to do then is if we have any mortgage interest, so the only expenses that would be allowed are items that we can do on Schedule A of our own personal return. And if this is our second home, because if you remember way back to Chapter 5 in Week 6, mortgage interest, you're allowed to take it on your primary home, and you're allowed to take it on your secondary home if you have a secondary home. So we could take interest on a vacation home. If you have more than one, then you can only take one. Real estate taxes, same way. If it's primarily rental, you almost never use it for personal purposes. You've rented it 15 or more days, so you've rented it at least over 2 weeks. And for personal purposes, not more than 14, or, key word here, not more than 14 or 10% of the days rented. Whatever is more, whichever is more. So you could rent it for more than you could be in it yourself for more than 14 days, as long as you've rented it. So if you rent it for 16 days, as long as you rented it for 160, then that's still okay. It's still considered primarily rental. And if it's primarily rental, then you are allowed to take, you go below 0 in net income. That's one of the biggest reasons why primarily rental is better. All losses are allowed, just like a regular rental home. The only thing you need to do is divide up your expenses between when you were there personally and all the other expenses that were part of the rental. And I tell you how to do that, and we'll look at some examples here in a minute. So you can determine how much you use your rental by just simply taking the days rented, say 160, and I just made up, divided by 176 because you used it for 16 days, and the time rented would be way up there, 85–90%. Anything else, so anything that falls in between, is considered rental or rental/personal use. It's a typical vacation home. So the key is you're not allowed a loss. That's the biggie. So it's better if you have primarily rental where you can take a loss. No loss allowed if it's a combination of rental and personal. Again, the expenses must be allocated, just like what we did up here. How much you rent divided by how much your total home was used. Renting plus what you had. No losses allowed. No carryover. You could switch over some of your real estate taxes and mortgage interest to your personal return on Schedule A. So typically expenses are allocated, like I said, between how much is rented divided by total days used. That includes yours. That's called the IRS method, and that's the typical one. The tax court has stepped in and said, if it benefits you for these two items only, for mortgage interest and real estate taxes, since you can use those on your personal return, they allow you to say if you were in it for, if you rented it for 50 days, and then you can take the number of days and divide it by a whole year. So that puts less of the Schedule E money on Schedule E and allows you to use more depreciation and more other expenses. And then you can use the much bigger percentage, 315 days, in this little example, for your personal tax return on Schedule A, for your personal itemized deductions. That may up that so you get to use it in which way is more convenient for you. So that's the only two methods that do allow you this other method of recording a percentage use. Most of the time you do have to use that first formula, total days rented divided by total days in the home. The tax court method says you can allocate it based on days rented. I could take out the 50s, that's confusing. Days rented divided by total days in a year, 365. So that allows more other expenses to go on your Schedule E if you hit that 0 mark, and more than to go on your Schedule A. Okay, so we got to count expenses in that same order as before, where we take the mortgage and real estate interest first, all other expenses second, and then depreciation last. Travel expenses 100% deductible. You don't have to do that formula, days rented over total days. So your mileage you get to use 100% as long as you had no personal use of your vacation home at that time. You were there simply for work. All right, let's look at this example I have. Vacation home is rented 200 days, personal use 50. Let's go back to the main rule here. Did you use it for more than or less than 15 days rented? Absolutely not, so it's definitely not primarily personal. Did you use it for more than 14 days rented? Yes. And personal days, 14 or 10% of the days rented. 10% of days rented would only be 20. We used it 50, so it's not primarily rental. It's the combo. It's rental / personal use, so we cannot take a loss on this property. Let's go through and look at some of these items. We had total rental income of $14,000. How much we're allowed to depreciate? I give that to us. Utilities. This is total utilities, total depreciation. How much maintenance there was on the house. I give us the real estate mortgage interest. And notice these two: replaced roof and build a new gazebo. We're not allowed to take a deduction on those. We would have to depreciate those. Those would be considered those capital expenditures, items that are large, one-time items that are going to increase the value of the home, not an ordinary expense. So these are kind of extra information. They would be included in this $5,000 depreciation number. How much income or loss would be claimed with this vacation home? Use the tax court method. Basically, it doesn't need to be said, but it could be said there, when applicable. So the tax court method can only be used on a couple items, not everything. Okay, so let's look through the answers. First thing we want to do is do the mortgage and real estate taxes. Those have to be done first. And I mentioned here, do the tax court method. The tax court method says take days rented divided by 365. Back up here in my problem, I said we used it for personal 50 days. So the home was only used for 250 days total. So if I was to use the IRS method, which I do give the comparison, the 5,200 simply comes from taking the 6,500 total mortgage interest. Go back up to the main problem. The mortgage interest for the year was $6,500. But we can't take all of that because some of it was for personal reasons. We were there for personal use, some of that 6,500, so I can't count it all as a Schedule E deduction. If I was to take that 6,500 and then doing it the tax court method, says days rented divided by 365. That's how I got the 3,562. The IRS method, what I did is take 200, but instead of dividing it by the 365, dividing it by total days used totally. So that's 200 divided by 250. And that's why it's a much higher number. It's a higher percentage being able to use the 6,500. So the difference between the 3,562 and the 5,200, the difference, whatever that is, if I use the tax court method, I would put the extra 1,700 thereabouts on Schedule A and get to use it there as long as I do and am allowed to have enough to itemize. Same with real estate. 3,500 was the total taxes paid. Doing it the tax court method says days rented over 365 instead of days rented divided by total days, 200 divided by 250. So a much higher percentage, thus more of the 3,500 using over here, meaning less available for the other expenses like depreciation. So the difference, about $900, can go on to my Schedule A, and I get to use it, not have to lose it. So when I take out revenue minus the deductions here, I'm down to net income showing. Utilities, remember we have to use the IRS method. There is no tax court method for any other expenses. So days rented divided by total days used. So out of the 2,500 in utilities, I can use 2,000. Same over here, 2,000. 800, 800. So that leaves me with net income before depreciation, 5720 left. Depreciation, if I have 5,000 total I'm allowed to use, I can take a percentage of that. So I can take 4,000. I could use all of the depreciation in that case and have a net income of 1720. Or I could say, yeah, I'd rather use the IRS method. I'm going to limit myself on some of the depreciation that I'm going to take, but therefore I'm not going to have any income to report, thus no income to be taxable either for my tax return. So whatever one suits you better. Is it better for you to have a little bit of net income here, but get to use the extra 1,700 for mortgage on your Schedule A and use the extra 900 in your real estate tax on Schedule A? Does that help you out more, or is it better just if you don't have Schedule A, it would definitely be better to use the IRS method if you don't itemize. So I had the same info above, except the home is rented for 50 days and personal use 25. How does that look differently? And I can't remember if I've actually worked that one out or not. Okay, yeah, I did. Nope, I didn't. The last example that I do have, though, if it's rented 12 days and personal use 100, well, we go back up, and if it's rented less than 15, so 2 weeks or less, we don't have to count any of the income. So the claim would be 0 income and 0 expenses. You remember that rule. Back up into the middle. Okay, let's close out that one. And briefly, we can look at, I have for you to go through on your own. Number 34 in the back of the book, a couple of these you may want to work out before you do the homework to see if you've actually got the method down, got how to take the depreciation, how to do the difference between the IRS method and the tax court method deductions, and then check your answers versus what I have posted. So I have all these posted there in week 8, not week 8, chapter 8, week 14. Next week will be our last video session, our last lecture, where I'll go through everything to close out the year, which includes, of course, the going over the final exam review guide that I have posted for you as well. Your proctor forms have already been sent out a long time ago with the midterms, so you should be able to make an appointment at any time that you need. Okay, again, as mentioned, this was a shorter lecture, and I hope you got something out of it.